Welcome to Real Estate Talk, part of the Realty Media Group. We also produce The Property Show, Real Estate Uncut and CoreLogic's auction updates. All available for catch-up anytime at realty.com.au. Before we get underway, thanks to BMT Tax Depreciation, Printforce and Propertyology for their support. Welcome. Do you know what your DTI is? Do you even know what a DTI is? Well, if you don't, that could be your first problem. But don't panic. Bushy Martin's last word today is going to explain it quite clearly. Also today, Bushy is joined by Darren Kingdon to explore what is possible in your SMSF if you want to undertake a development. And yes, it is possible, as you'll hear today. Bushy is joined by property PR guru and valuer Kieran Clair today to answer our questions about the valuation or the valuation variation in the price that you pay for a new build and what the valuer is going to tell the bank. And we wrap up this week with the property professor, Peter Koulizos, on how to avoid paying too much in a buying frenzy. Now, that makes for a pretty interesting show, so let's get started.
Welcome. For many years, there's been a perception that self-managed super funds can't build or develop property. But is this really the case? And if you can, how do you go about it? To discuss this, I'm joined by leading self-managed super fund specialist, Darren Kingdon, who's the author of Master Your Super and a very well-respected financial planner. So good to see you again on Real Estate Talk, Darren.
Yeah, thanks for having us, Bushy. Good to see you, mate.
Thanks, mate. Now, it's a really interesting subject, and there have been, I think, a lot of misconceptions around this, but can a super fund develop a clean skin property?
Well, the short answer is yes, but as usual, there's a few caveats with these things, and I guess you alluded to potential confusion out there because over the years, the ATO is basically the regulator of the self-managed super fund, and they've provided some mixed signals about whether or not super funds are allowed to develop properties on the pretense that the trustees might be carrying on a business which is thought to be a breach of one of the covenants of the super laws. But generally speaking, over the last sort of 10 years or so, the ATO sort of poured cold water on that, and generally speaking, it seemed to be an acceptable practice, but it does depend on the manner in which you go about developing the property. So, for example, can a superannuation fund develop a property that it already owns within the fund? And the answer to that is, well, yes, it certainly can, but you can't go and sort of add extra borrowings or securitize the asset, and it'd have to be effectively self-funded. So therefore, there's got to be probably contributions coming in that could cash flow the development, or maybe you need to liquidate some existing assets. It's got to come from within, or maybe rollovers from other funds. So that would be effectively how you'd be able to do a development without any borrowings. And similarly, if a property was acquired on the open market by a super fund, same sort of scenario would apply. Yes, you can acquire, provided that's all self-funded and they're not securitizing any assets, the super fund would be able to go along and improve the property and develop the property.
Okay, so let's talk about a greenfield exercise then. And let's say you're in a position where the self-managed super fund would need to borrow funds put towards something. Are you able to borrow funds to actually construct a development?
Generally speaking, no, but there is a couple of circumstances where it might be possible. And one of those circumstances is through like an unrelated unit trust structure, which is, say, where, for example, if we went 50-50 via a unit trust, me and you and my super fund and one of your entities, that would be a way in which we could effectively get some geared exposure, and that entity in which we're sort of 50% investors, it could go about securitizing assets, developing properties, improving properties, things like that. So that's a potential avenue in which you could develop a property, but it would require, I guess, independent, unrelated people like me and you to be able to make that exercise work. And I guess that's one way in which it could occur. Another way in which it might be able to occur is if the super fund already had a borrowing arrangement in place, and you're wanting to improve that property. Well, that property could, again, the improvement would need to come from existing reserves, contributions, rollovers, things like that, even though there might already be some debt attached to the asset, provided we only improve it and don't fundamentally change the character of it, which gets into a bit of legalese. Then that's another way in which it could possibly occur. But I think from practical experience, you tend to find if it's more about, well, if we invest jointly via a trust structure, and that trust structure isn't deemed to be a related party, given that we've got independent minds and wills, in undertaking the exercise, then that's a way in which you can get a sort of indirect geared development exposure into a portfolio.
Yeah, interesting. Okay, well, that's quite eye-opening, because that certainly changes a lot of people's perception of what you can and can't do in relation to the development space with super. So really thank you for coming on today, Darren, to open our eyes to that.
Yeah, much appreciated. Good on you, mate. Speak soon.
Thanks, Darren. So if you want to find out more about all of this, feel free to reach out to Darren at kingdonfinancialgroup.com.au. Make sure you grab a copy of his book, Master Your Super. I'll get it right the third time, Darren. Master Your Super. It is a really good read. So he has this ability to turn complexity into something that's very understandable. So grab yourself a copy of that. In the meantime, stay with us, because you're here on Real Estate Talk.
Property deductions can save you thousands of dollars each year. To make sure you maximise deductions, you need to work with the most experienced quantity surveyor in the country. BMT Tax Depreciation is the leading specialist in the industry. They've completed over 700,000 tax deduction schedules for residential investment and commercial properties Australia-wide. BMT guarantee to find double your fee in the first full financial year deductions. Call BMT on 1300 728 726 today for an obligation-free quote.
Welcome. Now, in recent times, we've seen a raft of stimulus measures that are really prompting increasing new build activity. We've seen home builder and a whole series of others that are pushing up activity in that new build arena. And again, this is okay, but where the challenges arise are if you're relying on bank borrowings to build a property, then we have seen, and we've seen for quite some time, some potential variations between the contract price and the bank valuation. So to discuss why this might be the case and what you can do about it, I'm joined by Kieran Clair from Bricks and Mortar Media, who's had been a very successful professional valuer for over 2 decades. So welcome back to Real Estate Talk.
Thanks, Bushy. I've had to take a break from my very successful valuations to spend time with you, but that's okay.
That's good to hear, mate. No, you've. What I love about what you do is that you're active in the industry, but now in what you do from the media, you actually give us much more objective and independent views of that. So that actually holds a lot more water to me, mate. So. Which is great. But, mate, digging into that new build subject for a minute, why are we seeing bank valuations on new builds come in below contract price?
Yeah, it's a pretty hard call, this one, Bushy, because what's drummed into you as a valuer straight off the bat is that cost never equals value. I mean, the idea is that when someone comes to buy a finished property, and that's what the bank wants to know the valuation is based on, they don't care what you paid for it. So, so those two, it's not simply a matter of adding land and improvements together. The number one thing I think is the problem is that the sales evidence you're required to use as a property valuer on new builds is that second-hand sales market. So the banks are coming along and saying, look, we're not interested in hearing about contracts on land. What we want to know is the houses just down the road who are maybe 6 or 12 months old that have sold from one first buyer to the next buyer. What are they trading for? And a lot of those sales don't really factor in that new house premium, that new car, new house premium that we often talk about. Because there is something about walking into a new home that you will pay a little bit more for that isn't picked up in that sales evidence. So I think that's where a lot of the gap comes in for that sector.
Yeah, that's a really good description of that, mate. Given that scenario, though, what sort of strategies do you think home builders can adopt to overcome or at least mitigate that?
Yeah, sure. Look, there is probably a couple of things you can do, and then there's a couple of things you can accept. It sounds like some of those Irish blessings you hear about, isn't it? Like it's things you can change what you can't accept, blah, blah, blah. In any event. So one of the things you need to accept is that perhaps it's going to be tough to find good sales evidence that's going to support your contract. The value is going to be tied to that, which means you do have to find yourself with a bit more deposit perhaps, or give yourself a bit of a financial safety net just in case that valuation isn't coming up. But the other thing you've got to try and do is avoid overcapitalization. Maybe have a little bit of a think about what you're constructing, the degree to which you're spending on the property, and whether that is going to stack up in the area. You don't want to have the gold taps at a valuation. You want the same sort of taps as everyone else has got. Playing into that, if you're going to put in a pool as part of your construction, but could do that maybe down the track and not include it as part of the valuation itself, you might find that pool overcapitalization can be pushed down and out of the way, out of the finance side of things. And maybe you can take care of that in a couple of months' time when a good friend's going to lend you $30,000 to finish off that work. So, Bushy, have you got? No, don't worry. I'll ask you afterwards.
I've got a swimming pool in my back pocket, mate. Don't worry.
There you go. If you just bring a shovel and some concrete, we'll be right, mate. So have a little bit of a think about those things that are maybe where the cost of putting them in is not commensurate to the value they're adding to your property, and see if you can work your way around not including those in the initial valuation. And the other thing that I think you can do, have a chat with your builder. I mean, if you're in this situation where you get a valuation, you're relying on the finance, and maybe there's a little opportunity to have a talk to the builder about, well, where can we shave things here to get this over the line? I wouldn't be too shy at that stage about trying to work with them to come up with a solution.
Yeah, really good thoughts. One of the analogies I heard, which you've probably heard 1,000 times, but if I go and buy a Holden Statesman, I'm probably showing my age now because they've been out of production for years, versus buying a Commodore, when the valuer rocks up, he just sees a Holden. And he's going to value it as a Holden, whether you've paid for the Statesman price or the Commodore price. So that's exactly what you're talking about there with the potential overcapitalisation. It's recognising that it's not what you've paid; it's how it compares to what everything else is sold of a similar nature. So
that's right.
Yeah.
I mean, you'll see that often as an example when people are building in locations which stack up to big spends. So in a city location, small blocks, and there's a lot of multi-million-dollar houses around, you can probably get away with spending 30K on a pool and it adding 30K to your build. Do the same thing in maybe an outer suburb where people are paying 400,000 or 500,000 for a property, won't stack up quite the same way.
Yeah, brilliant thoughts, mate. I always love your insights, Kieran. You have given us some good thoughts on what our expectations need to be if we are going into build, and why we might be seeing some of the valuations. So really appreciate you spending some time with us today, mate.
Not a problem, Bushy. Anytime, sir.
Thank you, Kieran. So stay with us for more after the short break. You're here on Real Estate Talk.
Property depreciation is the natural wear and tear of a building and its assets. Property investors can claim depreciation as a tax deduction each financial year. Depreciation is a non-cash deduction. This means you don't need to spend any money in order to claim it. On average, BMT tax depreciation fined residential investors almost $9,000 in first full financial year deductions. Call BMT on 1300 728 726 today for an obligation-free quote.
Now, it's fair to say that property values are going absolutely gangbusters around most parts of the country. And most recent CoreLogic data reveals that Australia's had house prices rising to almost 9% over the first 4 months of this year. And that's across all 15 major cities and the major regional centres. So to discuss the property feeding frenzy that we're now seeing, I'm joined by Real Estate Talk regular, the property professor, Peter Koulizos. Welcome back again, Peter.
Thank you, Bushy. Lovely to be back.
Thanks, mate. Now, love to get your thoughts straight off the bat in terms of why is there a feeding frenzy in the market at the moment?
Okay, so we can talk both property prices and property rents. And from those people that studied economics, price is a function of demand and supply. And this time around, it's not so much demand, even though we might hear about, lots of people taking up the home builder grant and so on, but that only affects the new home market, which is about 2% of the whole property market.
Yep.
It's the supply. It's people are not putting their properties on the market. On average, there is about 25 to 30% less properties for sale. Even if we had the same demand as we had, say, 12 months ago, property prices would go up anyway. But we do have increased demand because unlike 12 months ago, interest rates have dropped further again. So we've got limited stock. So there's limited properties for people to buy and rent and an increased demand. The rental demand is coming from people who are moving away. Firstly, if we look at it globally, like you've got people that were working in London, New York, Hong Kong, Singapore, coming back to Australia. Often they're heading to Sydney and Melbourne. And then we have people in Sydney and Melbourne heading off to other smaller capital cities or regional areas. Like in our little state, South Australia, for the first time in almost 40 years, we had more people moving into South Australia than moving out. Now, when you first go to a new place, you're not going to buy, you're going to rent, right? Exactly. So there's been a huge increase in the demand for rental property. And for those people that have been selling, because there are so many owner-occupiers in the market, on average, 7 out of 10 properties are owner-occupied and 3 are rental.
Yep.
So, but all 10 are being sold to owner-occupiers. So now there's 3 less rental properties. You multiply that by 1,000 or 10,000 transactions, that's a lot less rental properties out there. So it's to sum it up, Bushy, it's the lack of supply that is causing property prices and property rents to increase significantly.
Yeah, and that's an interesting point because people haven't got their head around the shortage of properties that are for sale. They're either not aware or they're ignoring that. Tell me, given that scenario, then how long do you think the current frenzy is going to last?
Well, I think some steam has already come out of the market. So the market is still red hot. It's not white hot. Like one example is character or period style homes in inner city suburbs are still going for a mozza.
Yep.
But whereas maybe 2 months ago you could sell anything and get a great price.
Yep.
Now some people are being a little bit more discerning and they can see, well, hang on, that's a rubbish property. I'm not going to pay a top price for that rubbish property. But it's still red hot. Like every capital city should see we'll see double-digit increases in property prices this year, and probably be led by Sydney, which will probably do over 20%.
Yeah, bit of spring back there, and the eastern states generally is going to see that. But we're also seeing pretty solid gains in the other capitals, which is very pleasing to see. And as you and I know, we've been in this industry for a long time, Peter. It comes in waves. We saw a similar activity back in the early 2000s.
Yeah. 2001, 2 and 3, they were great years. Yeah,
they were great years, and this time now is a similar great time for those that are into property. Tell me, what tips do you have for both buyers and sellers that they should be adopting at this crazy time, mate?
Okay, so for property buyers, this is not going to last forever. So you don't need to be in a mad panic to buy, because what can happen is you get caught up in all the emotion and you go to 3 or 4 or 5 auctions, you miss out and you think the next one, I'm just going to pay whatever it takes. Well, whatever you pay, that's going to stay with you for a long time, because generally the way the property market goes in many states is not much happens for many years, and then there's a spike, and then not much happens for many years, and then there's another spike. So if you pay top dollar today, it'll probably be worth that in 3 or 4 or 5 or 6 years time. So by all means, do your research and look at comparable sales. Don't bother looking at what sold 6 months ago. You need to look at what sold up to 3 months ago, no more.
Yep.
All right, if it's a great property, like a character or peerage style home in a great location, you might have to pay, let's say, a 5% premium. But geez, don't pay a 15 or 20 or 25% premium. So you need to calm down. You need to calm down. This won't last forever. As you said, Bushy, you and I have been around for a long time. And for most of that time, we've seen the market pretty steady. It's just these, short periods of time where it goes crazy. Property sellers, go for your life. If you've got property to sell, especially, if you've got investment property and you're in your 60s and you don't plan to sell and get back in the market, I think this is a great time to cash out.
Totally agree. Yeah, always a good advice there, Peter. I really appreciate you sharing with us some great observations. And with your role as the chair of PIPA, you've got a really good carriage about what's happening around the country. So I really appreciate you sharing those with us.
My pleasure, Bushy, anytime.
Thanks, Peter. The real take home from me there is that if you're investing for the long term, then don't get caught up in the FOMO frenzy. If you're like Peter and I and you're holding properties for 15 years and more, which most of us are, then this is just part of the cycle. Don't get too excited about it. Just focus on the fundamentals, get good quality properties in the right locations, hold on to them long term, and then get out of your own way and let the properties do their work. Excellent. So stay with us for more after the break here on Real Estate Talk. There's been a lot of talk recently about the banks loosening their lending criteria and relaxing the rules to make borrowing easier. And this is welcomed and necessary given what's happened in recent times. And to some small extent, this is true because we are seeing less scrutiny on your living expenses in terms of getting a loan. But unfortunately, with the number of variables and different criteria that apply to lending these days, often with banks, it's one step forward and 2 steps back. And one of those steps back that is really starting to bite with people looking to borrow money is the much bigger reliance by the banks on DTI. What's DTI? DTI is your debt to income ratio, and it can actually knock you out of the property race if you're not aware of its impact. So let me give you a couple of quick examples. If your total income is 100 grand a year and you've got $500,000 in total loans against your home loan, car loan, personal loans, credit card limits, etc., then your DTI is 5. It's the 500,000 divided by the 100,000 income to give you a DTI of 5. Now, let's say that on that $100,000 income, you've got virtually no expenses. You're looking to get a rental property and the bank servicing calculators are telling you that you can borrow up to $1 million. You might say, fantastic, let's go and buy a property. But what you may not be aware of is that many of the banks are now capping your DTI at a level of 6 or slightly more. And in fact, some banks will automatically decline your application if your DTI is in excess of their maximum limit. But the key thing to be aware of here is that the DTI treatments that have now crept in vary tremendously across the banks. And in fact, some banks still don't worry about DTI at all. And in fact, those that don't come under the Australian Prudential Regulation Authority don't have the same requirement to do so. So how do you maneuver yourself through this ever-changing maze in the lending landscape? Well, my best advice is to make sure you're working with a good and savvy mortgage broker, because a good and savvy mortgage broker will have access to up to 40 different banks and 2,000 different loan solutions, and they will know which banks are likely to impose more strict DTI limits and those that don't. So do yourself a favour. Good mortgage brokers have a duty of care to be acting in your best interests. So make sure you look after yourself by doing that. That's the food for thought for this week. You're watching Real Estate Talk.
So that is what a DTI is. Thanks, Bushy. Catch more of Bushy Martin at his Get Invested podcast. And that's it for another show. A special thanks to Bushy's guests, Darren Kingdon, Kieran, Clair and Peter Koulizos. I'm Kevin Turner. I look forward to seeing you again next week. Real Estate Talk, part of the Realty Media Group. We also produce the Property Show, Real Estate Uncut and CoreLogic's auction update shows. All available for catch-up anytime at realty.com.au. Thanks to BMT Tax Depreciation, Printforce and Propertyology for their support. Watch out for us in your inbox next weekend or catch us anytime at realty.com.au.